Welcome back to Financial Triage, where we talk about financial planning and how it impacts your finances. We are going to cover a lot of information in each episode. As everyone is in a different place financially and has different values and goals, not all of this information will apply to you. You can download the slides by using your camera app on the QR code, which we will show periodically during this broadcast. If you have questions, please note them in the chat, and we will answer all questions at the end. As we are going through these topics, if there is a particular segment, topic, or situation you would like to see a future seminar about, please leave it in the chat or email the organizers at academy@bedfordpresbyterian.org. My name is Jennifer Climo, and I've been providing income tax advice to individuals and small businesses for over 30 years and been providing financial planning advice to individuals and couples for over 18 years. I'm a certified public accountant, CPA, and a certified financial planner, CFP. The views expressed today are mine alone and are not the views of either Bedford Presbyterian Church or Milestone Financial Planning. Nothing you hear today should be considered investment advice. Do not make decisions based on this or any other seminar, but instead meet with a qualified financial advisor regarding your specific goals and financial circumstances. Note that almost all financial decisions will impact your income taxes or estate taxes now or in the future, and the tax consequences should be evaluated before you take action. Past performance of investments does not predict future results. TRIAGE is the acronym we came up with for this series of classes. Today's topic is the A in TRIAGE, asset protection, aka patch the leaks. At the end of today's class, I hope you will understand how to protect yourself and your loved ones in case something happens to you and protect your wealth at the end of your life. 1 Timothy 5:8, anyone who does not provide for their relatives and especially for their own household has denied the faith and is worse than an unbeliever. Protecting your assets is a form of providing for your family, especially if something happens to the main breadwinner in your family. Emergency fund. The standard rule of thumb is that everyone should have 3 to 6 months worth of expenses of cash in an emergency fund to pay for emergencies that might arise, a new roof, a broken boiler, a job loss, etc. You can adjust these amounts based on your situation. If you have a stable job in a stable industry, you might determine that you don't need that much cash on hand. However, one of the lessons we learned from this last pandemic is that your situation can change drastically fairly quickly. Honestly, the amount of cash you keep on hand is a reflection of your risk tolerance. You can choose to keep 3 to 6 months of just your fixed expenses on hand on the assumption that you could fund any problems from other sources of income. If you have adequate life, disability, and health insurance, you might want to reduce your emergency fund balance as your risk is lower. Where should you keep this money? I mentioned this at the end of the investments class last week. I would keep it in a high-yield savings account, a high-yield money market fund such as Ally Bank, Synchrony Bank, Capital One, E-Trade. There's a bunch of them online. As interest rates rise, the interest rate on the account should also rise. The goal is for the money to just sit there, like an insurance policy. Of course, that can be concerning during times of high inflation, as it is losing money every day. Unfortunately, if you want a specific principal amount, there isn't a lot of choice for you, as higher income means higher risk, and this is not money you should be risking. Life insurance. The purpose of life insurance is to replace your income and pay for one-time expenses such as funeral, college, state taxes. If you are under age 55, you probably don't have enough life insurance. No widow or widower has ever told me their spouse was overinsured. A rule of thumb is 10 times your income, but the recommended amount for you is heavily dependent upon your specific circumstances. There are 2 main types of life insurance, term and permanent. Term life is like renting. You pay a lower premium for a set term, and then it ends. I often suggest young people buy a large 30-year term policy. As the older you get, you may find it harder to qualify for inexpensive term life insurance. In addition, if you have a health event, that may make it so you don't qualify. The idea with term is that you won't need it anymore by retirement age because you will have saved enough assets to fund your retirement by then. Term life insurance is super cheap when you are young. Note, this is different from the life insurance you get at work. Work life insurance is usually very expensive compared to term, except at very young ages. This is because it is 1 year renewable term, meaning the premium is adjusted every year based on your age. That's great when you're young, but very expensive once you get to be about 40. You're better off getting a cheap 30-year term policy by about age 30 or 35, but you want to make sure you're still insurable then. The more healthy you are, the cheaper the premiums. Since it's hard to know how healthy you're going to be, I suggest getting it early, as early as you can. Permanent life insurance is much more expensive than term, as it has to last forever, no matter how long you live. This is appropriate when you have permanent needs that you can't save for, such as a large estate tax bill, a special needs trust that pays for your child that won't be able to live on their own. Most people do not need and cannot afford permanent life insurance. As an example, it may cost the same to buy a permanent life insurance policy of $250,000 versus $1 million of a 20-year term life insurance policy. Big difference. You can usually get a ton more term insurance than you can permanent insurance. Some permanent life insurance policies build up a cash value. The cash value may even earn interest each year. However, the cash value usually disappears at your death unless you buy life insurance on your life insurance. You can borrow from your life insurance cash value while you're alive. That's great, but you could, if you were saving in a savings account, just spend your savings account without it being tied up in an insurance policy that has fees. My advice is to keep your investments separate from your insurance. Again, regarding employer life insurance, if your only life insurance is through your employer and you are still insurable, run out and buy term life insurance. Don't make the mistake of only having employer life insurance. When you leave your job, you lose your life insurance, and you may now not be insurable. If you are young and a high earner, you may need $1 to $2 million of term life, if not more. Most people vastly underestimate the amount of life insurance that they need. And when you're young, it's super cheap, again. Especially important if you have children or recently married or if your spouse doesn't work. Disability insurance. This is the most important kind of insurance. You are much more likely to become disabled than die when you are young. Remember, everyone's going to die, but not everybody is going to die when they're young, and that's really when you would need the life insurance for something unexpected. If you pay the premiums for your disability insurance, the benefit is not taxable to you. Insist on this option. If your employer pays the premiums for you and doesn't add the value to your wages, the benefits will be taxable to you. Greatly reduces their value. It seems like a great deal, employers paying our disability insurance. It's not. You need to be paying it from an after-tax perspective. Let's talk about what an elimination period is. This applies to disability insurance, and long-term care insurance also has this term in it. An elimination period is the time from the disabling event before the policy pays. It's often 30 to 90 days, somewhere in that range. This is why short-term disability insurance is also important. That elimination period is often only 7 days. For an example, if you're disabled on January 1st, your long-term disability insurance policy has a 60-day elimination period. It means your first benefit payment will be March 2nd. How are you going to pay your bills for those 2 months? That's where short-term disability comes into play. Disability benefits are limited to 60 to 70% of your income. This is because it wasn't designed to pay your taxes. It was supposed to just pay your net income. If you pay the premiums pre-tax, or again, if your employer pays them for you, you are subject to taxes on the income and will net only about 40% of your salary. So if you really want to cover your salary, really, really important that you end up paying the premiums. Some employers allow you to do that, some don't. Private disability insurance costs about the same as the weekly benefit per year. For example, $10,000 a year in premiums will get you about $10,000 a month in benefits. It's very expensive, very expensive. The lack of disability coverage can tank a financial plan. Disability coverage really matters. For example, there is a definition of being able to work that includes your own occupation or any occupation. Clearly, if a surgeon can no longer perform surgery, their income is going way down. And they need an own occupation policy, not an any occupation policy, because they might still be able to teach, for example, but obviously salary would be a lot lower. But if they have a hand problem and can no longer perform surgery, they really need an own occupation policy. Reading the policy is super duper important. Employer-sponsored disability insurance usually does not have very good terms, rarely has an own occupation definition, but it's better than none. And it's often the only disability people have. You can often layer a private disability policy on top of it as well. If you are a member of a professional organization, such as a CPA, engineer, teacher, doctor, lawyer, or more, you might be able to get a more affordable policy from your state professional organization group. These also may have better terms than basic group policies. For example, I know there is medical for doctors group coverage that they focus on that own occupation definition. Same with CPAs. CPAs can get disability insurance through the AICPA professional organization much more cheaper because it's on a group plan, a large pool of people. The group is just whoever belongs to the association. So if you have such an association, I suggest you look into that for your disability insurance. Health insurance. We're going to talk about a lot of different definitions here. There's a lot of lingo with health insurance, and it's super confusing. We're going to talk about HMOs versus PPOs. PPO is a preferred provider organization. This has the most flexibility. It has more expensive premiums, but you can generally choose any doctor in your network, or you can get less coverage by going out of network, but you still get coverage. You are not required to choose a primary care doctor up front, and you don't need referrals to see specialists. This is the best kind of coverage because it is the most flexible. HMOs, health maintenance organizations, have limited choices. They have copays, which we'll talk about in a moment, cheaper premiums typically than PPOs. They require a primary care physician, and you need a referral to go see any specialist. If you are fighting with your insurance company for coverage, it is likely an HMO. In New Hampshire, unfortunately, the individual insurance market through the exchange only offers HMOs, which kind of stinks, but that's what you're left with. If you have a choice between plans, choose a PPO. The PPO versus HMO discussion also applies to Medicare plans, which we will talk about shortly. The general advice is stay away from the HMOs. Don't be tricked by their cheaper premiums. It's more expensive. It can be more expensive in the long run. Now we're going to talk about the difference between an HSA and an FSA. An HSA is a health savings account. It's an account that is yours forever, grows tax-free, and distributions are tax-free as long as you use the money to pay for medical expenses. You can only open an HSA if your health insurance plan is HSA eligible. Just because your health insurance plan has a high deductible does not mean it is HSA qualified. HSA qualified health plans will usually have the word HSA or saver in their titles, and if you aren't sure, you can call your health insurance company and check with the provider. If you have an HSA eligible health insurance plan, you should fully fund your HSA to the maximum limits, which are $3,600 single, $7,200 married filing joint, and that changes every year, usually goes up a little for inflation every year. You can contribute an extra $1,000 per spouse over age 55. Those contributions can come from you, your paycheck, or from a transfer from your bank account, or from your employer. But the combination of those three sources can't exceed those limits. HSA balances, again, grow tax-free if used for medical expenses, but you can't use them for health insurance premiums. They can be invested. In addition to growing tax-free, you also get a tax deduction for the contribution. Better yet, if you can contribute to your employer pre-tax, then you also save Social Security and Medicare taxes on the contribution amount. A little tip, if you have the cash flow to pay your medical expenses, let you contribute to your HSA, you invest it, it grows tax-free, and you pay your medical expenses out of cash flow. That just becomes another tax-free retirement account for you, if you're able to do so. You can always save up your receipts, and at any time in the future, you can reimburse yourself from the HSA tax-free for those medical expenses. You will certainly have medical costs in retirement, usually prescriptions, often glasses, hearing aids, and dental care, among others. Once you are enrolled in Medicare after age 65, you can no longer contribute to your HSA, but you can still use it to pay for your expenses. Or you can continue to let it grow tax-free. If you are still working at age 65 and covered by an employer-sponsored health plan, you may want to delay signing up for Medicare, if allowed by your company, so you can continue to make an HSA contribution. Because again, once you're on Medicare, you can't make a contribution to an HSA. An FSA, flexible spending account, is an account with your employer that you use for medical expenses during the year. You contribute to it out of your paycheck, but if you over-contribute and don't submit enough receipts or incur enough medical expenses to offset it, it's lost if you don't spend it. The account is not yours to keep. Contributions are made pre-tax through your paycheck. HSAs are preferable these days because they're portable, they're yours, fewer complications. More terms to talk about when you come to talk about health insurance. Copays. Copays are the amount you pay every single visit. This usually applies to HMOs, but every time you go to the doctor, you have to pay $20 or $50 or some amount of money. That's a copay. Deductible is the annual limit you pay before the insurance company pays the rest. Copays are on top of deductibles. If you have a $5,000 deductible, you will pay the first $5,000 of any medical bills before the insurance company pays anything. Exceptions to this are made for routine preventative visits like physicals, and HMOs can have other exceptions to that as well. Coinsurance is the percent you pay of any balances due after your deductible. If you have 20% coinsurance, then after paying your deductible and after paying your copay, you pay 20% of the remaining balance up to your total out-of-pocket limits. Out-of-pocket maximum, OOP. This is your total copays, your coinsurance, and your deductible for the year altogether. This is the number that matters when you're evaluating health plans. This is your total exposure. When evaluating health plans, your catastrophic worst-case scenario is your OOP. In my opinion, this is more important than your annual deductible. When comparing plans, make sure you compare their annual out-of-pocket max, as you can't exceed it. Even if you have a 20% coinsurance, if you've hit your out-of-pocket max, you're done. You don't pay anything else. Health premium tax credit. We discussed these during our taxes seminar. In 2021 and 2022, the credit is available for anyone not covered by employer-sponsored health plan. That is, if you get your health insurance at work, this does not apply to you. This law means that health premiums are limited to 8.5% of your income in 2021 and 2022. No credit is available if your income is below 138% of the poverty level because you qualify for Medicaid at that point. Or if you have employer-sponsored health insurance and you don't enroll and the cost is more than 10% of your household income, you can also qualify. But in general, if you get your health insurance through work, you can't also get an exchange plan, so you don't get this tax credit. This is the schedule of poverty levels. If you were a single person earning less than $17,609, you are eligible for Medicaid, which is free health insurance. This can be based on your current monthly income when you apply. And your household, by the way, is defined by your tax return, how you file your taxes. Note that there is no asset test for getting Medicaid health insurance, only an income test for people that are not on Medicare. Make sure you provide your Form 1095-A to your tax preparer. You will get this every January. They can't claim the tax credit without it, because you have to reconcile the advance tax credit they give you, if they gave you in advance, with what you actually received and report it on your tax return. And again, you'll get this tax form in January each year. It will say, important tax document. As the tax preparer myself, please give us the 1095-A. Medicare. Medicare is generally applicable to people over age 65 that paid in a certain amount of Medicare taxes during their working years. Medicare has parts and plans. Parts are the different kinds of medical coverage within Medicare. Plans are the different supplemental medical coverage plans that layer on top of Medicare Part B. So plans only apply to Part B Medicare. Note there are only 10 plans currently, A through E, G, and K through N. Back to parts. Part A is hospital insurance and is free, assuming you have 40 quarters of work history, 10 years. Part B is medical insurance, and the base cost is currently about $150 per month per person, higher if your income is over certain limits. You also need to purchase a Medicare supplement plan to cover what Medicare does not. Medicare generally does not cover vision, dental, hearing aids, or glasses. If you were over age 65, you should plan for combined health insurance premiums of about $400 a month, plus medical expenses of another $250 a month per person, more if you're subject to IRMA Medicare premiums. And obviously, this is a generalization, but in general, that's what we use to budget. Medicare Part B is medical insurance and needs to be paired with a supplemental plan that you pay for. The current alphabet soup of available plans includes, again, plans A through E, G, and K through N. Plan G is now the most comprehensive. Plan F used to be the most comprehensive, but it is no longer available to new Medicare recipients, which means the cost is going to go up for existing recipients because the cost is based on historical claims data, and there's no new healthy 65-year-olds being put on it. Unfortunately, you can't change Medicare Part B plans once you're on them without being medically screened. So it is very important to choose the correct plan up front when you're looking at Medicare Part B plans. Compared to Plan F, Plan G doesn't pay the $203 Medicare deductible. Compared to the existing high deductibles of health plans for people under age 65 these days, $203 is not much. In general, you need to medically qualify to switch Medicare supplement plans. So those currently on Plan F may not even be able to switch to Plan G. Over time, the federal government keeps taking the best plan and retiring it, so you may want to consider a lesser plan than even Plan G under the assumption that that one will get grandfathered, retired in a few years. What is Medicare Part C? Remember, Medicare has parts. We already discussed A, hospital insurance, B, medical insurance. Part C is an HMO plan that covers A, B, and D in one plan. It's usually cheap, but there are the similar downsides as there are in any HMO. These are known as Medicare Advantage plans. Brokers receive higher commissions for selling these, which is why you see them advertised all over the place as being awesome for you, and they're free or super cheap. You get what you pay for. We usually advise clients to avoid Medicare Advantage plans primarily because the coverage isn't complete, and you may find yourself paying for uncovered services or fighting to get something covered. Part D is prescription drug coverage. These premiums are separate from Medicare Part B and are also income dependent, higher for those with higher income. What are IRMA Medicare premiums? This extra tax was passed in 2003 and is known as the Income-Related Monthly Adjustment Amount, or IRMA. It ties your Medicare premiums to your income. In 2011, this tax was expanded to apply to prescription drug coverage, which is Part D, as well. There are now 6 income tiers for IRMA. And this is the IRMA schedule for Part D, prescription drug coverage. When can I change plans? If you want to change Part B plans the medical insurance? The answer is never, unless you medically qualify, which is pretty tough if you're over 65. Medicare open enrollment is sort of a misnomer, but it's called Medicare open enrollment from October 15th to December 7th every year. This is when you can choose a different Part D prescription drug plan, or you can switch to or from Medicare Advantage, Part C, the HMO. Part C also has its own open enrollment from January 1st to March 31st. If you enroll in Medicare Advantage, you have 12 months to switch back. As I mentioned above, you cannot change your Part B supplement plan unless you're medically qualified. So this open enrollment only applies to Part D prescriptions or moving between traditional Medicare Part B and Part C, the HMO that covers Parts A, B, and D. Most clients use open enrollment to choose different prescription drug plans. Since I am telling you to probably avoid Medicare Advantage, aka Part C, the purpose of Medicare open enrollment is to choose a different prescription drug plan only. Penalties for late sign-up. If you don't sign up for Medicare at age 65 and you don't qualify for the exceptions, your premium will increase for life, 10% for each 12 months you waited. This applies to both parts B and D. Reminder, Part B is medical insurance and Part D is prescription drug benefits. There is also a late enrollment penalty for not enrolling in Part A hospital coverage, which is free unless you sign up late. The late sign-up penalty is 10% of the cost to the government, paid for 2 times as long as you waited to sign up. What are the exceptions to signing up for Medicare at age 65? Well, if you and your spouse, either one, are still working and covered by a large employer health plan, then you can usually delay without penalty. An important note, COBRA does not count as employer health insurance. So if you lose your job after age 65, you have to sign up for Medicare in order to avoid lifetime penalties. If you are collecting Social Security, you will be automatically signed up for Medicare. Once you are on Medicare, you can no longer contribute to your HSA, as we mentioned before. So if you or your spouse are still working at age 65 and covered by employer-sponsored health insurance, factor in the impact of contributing or not contributing to your HSA before you enroll. Later in life care. Health insurance covers medical costs only. It does not cover the cost of helping you when you can no longer do things for yourself, like transfer from bed to chair, feed yourself, toileting, etc. At that time in your life, your choices are move in with family, hire someone to come into your home to help, move to an assisted living facility. If you move before you have lost 2 of the 6 activities of daily living mentioned above, you have the option of going into an independent living facility or continuing care retirement community, known as a CCRC. In general, you have to be able to live on your own for at least a year to get into these places, and Medicaid or long-term care insurance usually does not pay for independent living. You have to fund that cost yourself. Let's discuss CCRCs specifically. Continuing care retirement communities. They usually don't accept Medicaid. You must be medically and financially screened to get in. Usually they require you to be able to live in an independent living for at least 1 year. You usually purchase your own apartment and pay a large monthly fee for services. Once you can no longer care for yourself, you can transfer to their medical wing. The CCRC buildings are usually one enormous building containing everything, all the apartments, a restaurant, tavern, diners, banks, hair salon, etc. And then also the medical wing, of course. All of this costs money, often a lot of money. If you don't have any money and you need help with daily living activities, Medicaid will pay for services. But you don't have control over where you go or whether you have a roommate. You go where there is room. If you are hospitalized, it can sometimes be easier to find placement in a nursing home through the hospital because they need the bed, so they have connections. If you're going from private, your own house, into a nursing home, that can be harder. Ways to pay for these costs include from your children, not an ideal solution, from your retirement savings, Medicaid, if you don't have resources, long-term care insurance, or some combination of all of those. Long-term care insurance. It's not health insurance. Health insurance does not cover long-term care costs. Medicare is health insurance. Medicare does not cover long-term care costs. The cost of long-term care insurance increases every year you wait, as it is still being priced and repriced in the market. A surprising amount of people keep and use their policies. The premium is higher for women than for men. Looking at the population of nursing homes and assisted living facilities, they're mostly women. Many companies now factor into premiums your family history of Alzheimer's disease, making it even more expensive. This insurance is activated once you can't perform one of the 6 activities of daily living, again, such as transferring from bed to chair, feeding or toileting yourself, bathing, dressing, personal grooming. It usually covers in-home care as well as facility care. A tax-qualified plan means you can deduct the premiums and there's no tax reporting of benefits. A non-tax qualified plan, you can't deduct the premiums on your taxes, and you will get a 1099 for all the benefits that you have to offset with the expenses. Note that if you are self-employed, you can deduct qualified long-term care premiums as part of your self-employed health insurance. You can also deduct Medicare premiums for you and your spouse if you're self-employed. It's a tip. Long-term care insurance is far cheaper than paying for the care yourself. The coverage may cost you $5,000 to $10,000 a year for a policy per person, but you will be paying $10,000 to $20,000 per month when you need this kind of care in today's dollars. Who knows what it'll be then? Contrary to Medicaid health insurance, Medicaid long-term care does have an asset test. Also, a certain percentage of your income has to be directed towards paying for your care if you are having Medicaid help pitch in. Nursing homes cannot discriminate against you based on how you are paid, but as I mentioned before, some of the facilities that are great for independent living and later in life care, such as CCRCs, they don't take Medicaid. One little quick story, I had a client that applied to a CCRC. If you might remember, you have to be medically screened and financially qualified. They want to see that you can pay for whatever the fee is, as long as you're there. And they counted her resources, and they also looked at her long-term care insurance policy. And you needed in there, they had some formula, you needed some amount of money to be able to get in, and they counted her long-term care insurance plan as $600,000. And that's how she was able to get in. Long-term care insurance is important. Don't wait too long. A lot of people that I see applying for it, over half of them are disqualified and are unable to get it. Again, because you have to be medically screened to be able to get it. Protecting your wealth at the end of life. Medicaid trusts. Medicaid trusts are a way for people who have money to give up control of their assets 5 years or more before they need care, and then qualify themselves for Medicaid, since they will no longer have assets. The assets are put in a trust that eventually passes to their kids or other heirs. But if you outlive your leftover money, you end up in a facility that takes Medicaid. The downside to this is you have less control over where you go, you may have to move, and you may have to share a room. In my experience, most trusts are broken after mom and dad run out of money to continue to pay for their care. Are you really going to move mom and dad from where they are living to an inferior location? Moving anyone in their 90s is a painful and difficult process. Medicaid trusts gives your trustees, usually your kids, the option of not spending your money on your care. If you transfer your assets into an irrevocable trust, you may have eliminated the step-up in basis at death and perhaps trapped large capital gains into a trust. Not necessarily ideal. Many lawyers will use something called an intentionally defective grantor trust to avoid this, removing the assets for Medicaid purposes, but allowing you to keep a step-up in basis at death. But Congress is trying to curb this exception in as yet unpassed tax law. The assets in these trusts cannot be used for your care and will pass to other beneficiaries at your death. You have to set up such a trust and transfer into it at least 5 years before you are eligible for Medicaid. In my career, I have never seen a Medicaid avoidance trust kept in place once the individual runs out of their own money. The kids usually bust it to pay for mom and dad's care. Therefore, you might as well just keep the money and avoid the expense. Also, these Medicaid trusts, to me, they seem like they're a really great deal for your kids and not so great for you. You got to think about where you want to be living at that stage in your life. If there is a chance you will run out of assets before your end of life, make sure you don't make any gifts in the 5 years before you're eligible for Medicaid, or else the state may claw them back to pay for your care. Since you don't know when you're going to need to qualify for Medicaid, you just need to be careful about gifting in general once you get to a certain age or a certain health status, if you think there's any chance you're going to run out of money. Asset protection trusts. These protect your assets from creditors. In order for these to work, you have to give up control over the assets. Also, having a trust doesn't guarantee you are protected, but it does provide quite a revenue stream for the attorneys. When I met with an asset protection attorney to see if this made sense for one of my doctor clients, it was evident there were so many exceptions and caveats and hoops to jump through that it just doesn't make sense for most people. I strongly suggest getting enough errors and omissions insurance to cover you if you are in a profession, and general liability insurance. The bottom line on protecting your assets other than insurance is that you have to completely give up control of your assets, which is practically difficult to implement. In addition, the cost to set up such a trust is prohibitive unless you have more than, let's say, $5 million to protect. Homeowners insurance and renters insurance. This protects your home and stuff and also provides liability protection. Make sure your homeowner's policy has an inflation adjustment to the coverage. Also, consider flood insurance. Homeowners insurance usually doesn't cover your basement or flooding of any kind. Flood insurance does cover your basement, up to about $250,000. Even if you aren't in a flood zone, consider flood insurance. Remember Hurricane Harvey, which stagnated over Texas with heavy rains for 5 or so days? Not many locations can withstand that kind of event. Also consider earthquake coverage. This is cheaper out here than in California, where they have a lot of earthquakes, but your normal homeowner's insurance does not cover this. Auto insurance is also important. Make sure all your household licensed drivers are on your policy. Check your limits for all coverages, and make sure your liability coverage is appropriate. I suggest you talk to your insurance agent about what limits would be appropriate for your situation. Many people's limits are way too low. Homeowners and auto limits for liability protection are usually much too low, only about $300,000, even when they're near their highest that you can get. If you have any substantial financial assets, 401ks, investments, other real estate, etc., I suggest adding an umbrella insurance policy. As its name implies, an umbrella policy lays on top of your homeowners and auto liability coverage to bring your liability coverage up to limits of about $1 to $5 million. This coverage is usually relatively cheap, only a few $100s a year for $1 million in coverage. Overall, a good financial plan needs to patch the leaks. There are always circumstances we cannot control, and you should protect yourself. Are there any questions on anything we discussed today? Yes.
For the term life insurance,
Yes.
What happens if you outlive the term?
Excellent question. It's like renting. It's all done. You give it back. It's done. So what many people do, so if it depends how old you are when you get it. Say you're 30 and you get a 30-year term insurance policy is common. That takes you to age 60. The theory is by age 60, you should have saved enough in your retirement assets that you no longer need insurance. That assumes you don't have a permanent need for insurance, which a lot of people don't. But some people do. I mean, if you have a one-time event, large estate taxes, or a supplemental needs trust that needs funding and you have no other way of funding it, then that can be a reason to do that. But good question. That's why if you get a policy, say you're at 22 and you get married at 22 and you get a 30-year term policy, it only takes you to 52. Oftentimes people will, every 10 years, they might look into getting another 30-year policy. And you wouldn't have to get the same amount. You get a smaller amount because you have fewer years to get you, and you can stack them. Problem with getting too little insurance too early is that you may no longer be insurable later on. So that's the risk that people take. But good question.
I have a question about insurance.
Yes.
My dad lives on Big Island of Hawaii, but he spends a lot of time on the mainland. Right now he's at my mom's in LA. But there is a friend who's staying at my dad's house, and he keeps insisting on driving my dad's car. If he got into an accident,
So that could be problematic. So if he has insurance, an insurance policy from somewhere else, usually your insurance policy covers you no matter what car you're driving. But that would be a good question for your insurance agent. I mean, some questions are arcane, and besides, state laws are all different too. So
Yeah.
Hawaii might have a very specific law, very different than New Hampshire.
okay,
But that's risky.
yeah,
But I mean, there's all kinds of insurance. If you have rental property, you need a special rental insurance policy. You can't have just a general homeowner's insurance policy. It, depending on what your situation is what kind of insurance you need. We just covered some of the basic categories.
When, on average, is it considered too late to apply for long-term care insurance?
This is a tough one. I've heard it said before that you should wait till you're 60 to apply. My personal experience is if you wait till 60, usually often there's a health event. I've had people that had like bad knees and bad elbows, and for whatever reason they couldn't get long-term care because of it. I can tell you that I bought long-term care insurance in my 40s. I have seen people buy it in their 30s. I mean, the earlier you get it, the cheaper it is, but obviously you're paying it over a much longer time period. So there is that trade-off, but for me, the risk of not having it, not being able to get it, outweighs the paying the premiums early. It's all risk management, and how much you want to protect yourself, and based on risk tolerance. Again, everything goes back to risk tolerance. But so my recommendation now today is if no later than in your 50s, should you consider it. Okay, thank you very much.